Shane, how's it going?
It is going, man. I am in northern Georgia and what they call mountains. A little different than the Rocky Mountains of Colorado, but there's some elevation change, which is much different than Florida.
Awesome. Yeah, much needed break. Sometimes it's funny. So Jesse Livermore, and reminiscence of a stock trader, said always good to take a break when the markets are tough, and right now they are. So maybe I don't know if that was your intent, but certainly good for some people, I think, to just step away and enjoy God's creation.
Yeah, if I weren't trading other people's money and if I didn't have to sit and babysit, a lot of assets that aren't mine and don't, if I didn't have to do that, I would be somewhere without any type of internet service or cell phone service. Jesse Livermore, he used to get a boat and go fishing. That was his thing. So, um, and yeah, that's kind of by design, but also like kind of have to stay on the grid because I've made a bunch of changes to portfolios over the past couple of days. I was making trades in the car while my wife was driving, which is abnormal. Normally I drive everywhere we go, but yesterday I was sitting in the passenger seat, you know, doing trades for our book of business as we're driving north on I-75. So technology is pretty cool, man. It allows you
Yeah,
to do some things like that. Um, so I'm grateful for it when it works. Hopefully the internet is stable enough that you can keep me on video and on audio here for this whole call. But if not, I'll just I'll mute it and stop the video and you can continue on.
sounds good. Well, so today is May 12th, and I just wanted to pull this up. So, always a good benchmark, and it's so common in the industry, is a 60% stock allocation, 40% bond allocation. And if you mirrored that using LQD and then ticker SPY, you'd be down 17% year to date. So, I was always taught that they would balance each other out and give me what's known as diversification. But looking at it now, I don't have a whole lot of confidence in that. So, what are your
Yeah,
thoughts?
the historical correlations are pretty much broken right now when it comes to stocks and bonds because I don't know. I mean, bond cycles tend to last, a few decades, 30, 40 years at a time. So from 1946 until the early 80s, um, interest rates were going higher. And ever since the early 80s until very recently, interest rates were going lower. And a lot of people, a lot of the studies that guys like you and me look at were done, since the 80s. And so bonds were kind of in a very, very long-term uptrend, while rates were going down. And now that's changed. So the correlations have flipped, and people who are depending on historical correlations to hold through this market cycle are going to be disappointed, I think. And I don't know when I was writing about it most recently. In my commentary, well, the most recent commentary, which just got posted earlier this week, certainly I brought it up, but I referenced an earlier commentary where I said pretty clearly that I didn't think a 60-40 portfolio was going to hold up very well. I want to say it was in my March commentary. So as of a couple of months ago, we were way ahead of that game, and turns out that a 60-40 pie chart prism portfolio is not what you would have wanted this year. Hasn't really helped at all. You might as well have just been long the SPY.
Absolutely. So, well, let's go ahead. Why don't we just look at the charts and see what the overall markets are doing? So,
Yeah, I'll
close
tell you
that out.
what, if you don't mind, I don't let me just make sure I'm ready to go. I was gonna jump in and just kind of get started with where we left off last week, which was with my personal trade in wheat, WEAT. So if I could share my screen, that might be good because I've got the lines on there that we discussed last time. So
Hmm.
so you can see what happened since we last talked. So when we last recorded, I think we were here May 5th. Is that right?
Yep.
Yeah, May 5th. So here's what happened since then. My trade failed and I stopped out right there. So and now of course we is up here at 11:36. But here's the good news is even though I stopped out of that first trade, which I was in at 11 and I was out at about 10.75. So I lost like 25 cents, give or take. I don't know exactly the number, but I bought back into wheat right about here. So my current cost is 11.11, I think, or maybe 11.15. And as we just jumped on this call, wheat spiked pretty good. I don't know if there was a release or a report or something that came out, but my new cost, is up here at about 11, like I said, about 11.15. And my new stop is here at the lows of that candle on the day I entered. So again, I'm risking about another 25, about 20 cents this time.
Mhm.
Hopefully to make a run back to the all-time highs, and if I'm lucky, maybe go beyond that. So even though I got stopped out on the first entry there, I am back in because this looks like a strong breakout chart to me. And as I was saying last week, the key on trades like this is to keep the stop tight, and give yourself a nice risk reward. So no point in having a stop if you're not going to follow it. You don't like hit your stop and then say, well, my gut tells me this thing's going to go higher. It's like, look, just keep your stop. And if you want to get back in, get back in. That's how we do this. So we'll see how it works out from here, but I just wanted to update everybody on that. And for the sense of full disclosure, like, we're not just sharing trades that work, right? I'm happy to share everything from the ones that we probably learn more from the ones that don't work out than we do from the ones that do work out. So just a good learning opportunity to kind of show you how I trade this stuff. And there are lots of ways to do it. So Kyle, you might do it a little differently than me, but this is what I've done so far, and I'm back in the trade and it's going my way.
Absolutely. And it is always the defining moments how you handle the loss, not how you handle the win. So having those stops in place is key.
Yeah, I mean, following stops is like religion to me. I don't break those rules. I just follow them every time.
Mhm. Sounds good. Well, you mind, I'll take the screen over here and we can talk through kind of the general markets.
Are you ready? All right. I'm trying to click stop. It's not working. Hold on.
I've got it.
Stop sharing. There you go.
All right. So SPY, and tried to be helpful to everybody here. I've got a weekly chart up. Reason being, right now we've had quite a bit of selling, and it just makes it where your bottom of the screen ends up being support sometimes on the daily. So backing up here, but we talked about this level last time, and I had that drawn, and we certainly did not hold that. And at this point, for me, that is the line in the sand. I'm bullish above it, but we're in bear country right now, and I don't see any support through here. From where we were talking here, we're down, decent amount, but from where we stand today to where I see a floor, I'm looking at about 10% lower. And that's just to go to the next likely level of support. I don't know if you're looking at any other levels, but that would put us at 351. That's about 3,500 on SPX. And we break that, I mean, who knows? Then you're going to start looking at levels through here, but I easily could see us going another 10% lower, and we might have some rallies in there for sure. But yeah, what do you think?
Well, for anybody who really wants to know what I think, I would encourage you to go to our website and check out the commentary I just posted a couple days ago. That is how I see it. So that's probably the best way to go find out what it is I think. But I don't tend to look at weekly charts too much. There's just, I don't know. There's not enough there for me to make a trade off of. So I still look at the dailies. And I can share my screen if you want, but as of right now, like as we are speaking right now, the SPY is down 18.14% from its high, which we saw, well, actually not even from the high. Sorry, that was for the year. Shoot, hold on. So from the high, which was on the first trading day of this year, SPY is now down 18.64%. And to me, it would be just a total shame to not get the full 20% down bear market move. I mean, we're less than 2% away. That move takes us to like 381, 382 on the SPY. And we're at 388 right now. So I mean, we could be in bear market territory by the end of the day. Market tried to rally out of the gate this morning, and as we were getting on this call, just dropped pretty hard back to being down. We're down 1% for the day now.
Mhm.
So to me, we're going lower. if we don't tag that minus 20% on this move, I'll be a little disappointed. But I think ultimately we will hit that down 20% target sometime this year, hopefully in the very near term. And as I outlined in my commentary, which you can find at our website, elevatecapitaladvisors.com. Kyle could probably put a note in the show note or a link in the show notes.
Yep.
You're going to see, some bounces. You're going to see multi-day bounces that go 3-4%, maybe 5% higher even. And then the sellers are going to come out, because I think what happens at this point is there's a lot of people still holding their positions that all they want is their money back now, right? Like they're people aren't real optimistic about the market going and making new highs. Like a lot of the people who are bag holders, as I refer to them at this stage, they just want some of their money back. Ideally they can get all their money back, but as the market rallies, people who wish they had sold along the way will they'll say, oh cool, I recovered some of my losses, let me hit the sell button. And so I think the market's just going to be in that kind of a situation for a while. And with the Fed tightening into slowing GDP, slowing inflation, tightening into a decelerating economy it spells disaster for asset prices, and that includes stocks and bonds, just like it includes milk and cereal and gasoline. Like they want prices to go down across the board. It's not like they want prices to go down except the stock market. It's all prices they want to come lower, and so there's not going to be any reason to be aggressively buying stocks, I don't think, for a while. But I'm covering some of my shorts down here, and I think a lot of other people are too. We're up a lot on those shorts, and you can't ride a short to zero, by the way. If you ride a short all the way to zero, how are you going to get out? Like it stops trading. You can't buy it back. You're just sitting there and you're like, wow, I was right, and I'm still not going to make any money. So, in fact, do you know how that works? I'm not like, I don't know how that works.
Yeah. So I thought we would touch on that. When we talk about a bear market and the fact that there will be rallies, why? So the reason is, so right here, we had a level of resistance that was established. Well, now you get over here, come up to it again, and you have two things at play now. So you have institutional money that now sees this as a wonderful place to short. And then you just see the average retail investor that's just been holding through all of this. Well, they ride it all the way down here. Well, now the people that shorted here, the institutions, they have a massive position that they have a really nice profit on because they borrowed the shares up here with the agreement to buy back down here to cover. And then you've got just your average retail investor that down here, it finally gets too painful. Well, the only way out of that trade is to buy that exact same share back, or, same ticker, obviously, maybe a different share, but close out those positions. So everybody races for the door down here, and it would be wonderful to exit all your positions here, but there becomes a point where a bunch of people don't want to sell right here and help fill that other side of the trade. So it pushes the price back up to try and get more buyers that are like, hey, now the price is going up, I'll sell out of here, and then allow these people to cover. So you get these fierce rallies up, and then when all that is transacted, then it can get that leg back lower going again. Or what could happen is it could come down here, kind of take a break and work its way back up. But that's why you see bear market rallies like that, is all these people up here that were just short, they have to cover, or the people down here that are your average investors, the pain becomes too great and everybody runs for the door no matter what the price, and they'll push that thing up really fast.
Yeah. I just wonder what happens. Like if you're holding a stock short and it goes to zero, it has that minus 100% day. Like, it doesn't trade anymore. So if you're short 100 shares of XYZ stock, or whatever it is, doesn't matter. There's a whole bunch of examples I could give. And the stock goes to zero and it doesn't trade on an exchange anymore. Like what happens to your position? I honestly, I don't know. I guess I was just asking.
I think my bet on that is you probably have to get an attorney involved and go start working with the company and the people that were on the other side of the trade, because whoever was long on that share now went to zero. They've lost everything
Yeah.
and they might not have liquidity to settle that trade.
Yeah, well, I'm sorry for any attorneys who are listening, but we all know that when the attorneys get involved, nobody makes any money except the attorneys. So that's why I never ride a short to zero. You don't want to be in on that minus 100% day. So like
Yeah.
you've got to cover along the way. I generally cover like 10% of my position when I'm up 10%, another 10% of my position when I'm up 20%, another 10% of my position when I'm up 30%. And by the time I'm up 30% and out of 30% of my position, I can do a lot of different things with a wide stop there to hold on to the position for the long run. And even if I get stopped out on the upside, I'm going to close it for a nice gain. So that's, I always try to take some of my winning trades off, as I go. Um, and then kind of see what happens from there. But I've
Hmm.
I've covered most of my shorts now. I'm still net short the market. I'm long wheat, and that's it.
Yeah.
So
And that's where right now, if you could re-enter a short here on SPY off the low of this candle, that's not a bad area to be. So 405.5. But right now with where we're at, there's no way I'm going long down here. I want to see it down here if I want to go long. And maybe I could go short here, but this is a time to go fish, go do anything else. It's a tough market because when you trade a bear market down too, the volatility will wipe you out.
yeah.
So now
Well, the
sig
biggest the biggest drivers, I think, if you want to go to Qs, that's fine because it'll be the same story. But
mhm.
the only thing that I think has been holding up the SPY and the Qs is the fact that Apple hadn't really broken down yet. I mean, it's down from its highs, but if you pull up the Apple chart, which I guess you got at the bottom of your list there,
Yep, I wanted to hit on
um,
that.
Apple finally kind of got taken out behind the woodshed yesterday. If you draw, well, I don't know, I could pull it up. It's hard to, you and I draw our lines differently, but if you draw a line connecting the the higher lows, going back to like 2021 March, you don't have to go back that far. Yeah, see, it's hard. I should just pull it. You're going back way too far, dude.
I'll let you take it over.
Oh, sorry. All right. Well, I wasn't prepared for that. Sorry guys. He dished me the ball and I was not really expecting it. All right, so back to so I got the SPY here. Uh Pull up Apple. And that's not really the chart that I wanted. Yeah, sorry guys, not prepared at all for this. So the line that I was talking about is simply, I think it's basically right here. If you draw this line right here, Apple was holding that level for this entire drawdown. I mean, it was down a bit from its highs for sure, but yesterday it really kind of broke down hard below those levels. I mean, it broke down a couple days before, tried to rally, and then yesterday really kind of smashed below. So, and then even got below, the prior low from March. So when that happened, when people are finally willing to sell their shares of Apple, which they want to hold for forever, right? That's what everybody says, is I'm going to hold this stock forever. Well, when the pain gets bad enough, all people will start taking profits and start trimming their position. And I'm sure a lot of people still have plenty of profits in Apple. We still hold it, in various portfolios, but we've trimmed it back a bit. And I think, to see Apple start making a move to the downside like that, at the same time, Microsoft is making similar moves. These are the two biggest stocks in the market. So when they both decide to fall like this, right? Things can get pretty ugly pretty quick because now there's nobody left to hold the market up. So I think that we're still in some pretty bearish territory, and even though we'll see some relief rallies, I don't expect a whole lot of upside from the market. So
Thanks, and I'll take it back over. But just we've talked about, so Microsoft, here's Apple, it broke that level. All that translates into the Qs and NASDAQ. And it's funny. So this is the level I drew at our last kind of recording, and we broke below that. And I would expect probably a little bit of a rally, but this is what I'm looking at next. So down here at kind of 260, somewhere down in that range. And that puts us on Qs another 12% lower. So,
which is how much from the highs?
good question. So from our highs, that would be 36%.
Yeah. Nasty. And
So,
where's the COVID low? Like 180 or something like that?
so the COVID low, that would put you down
Yeah, like 180. Oh
164.
wow, 160. Geez. And how far is that down from the recent high?
So from where we stand today, I'll do a couple levels. So I'll do from where we stand today, which would put us 44%.
Yeah.
That's a scary number. And then from up there, oh my gosh, I don't even.
Just take that existing arrow and drag it down. Yeah, or do
Yeah,
that. That's cool.
doomsday scenario. So that'd be 60% from the highs.
Yeah, well, anything's possible. I wouldn't rule any of that out because at the end of the day, I look at the entire rally since COVID as total nonsense. I mean, every bit of upside that happened since the lows during COVID was not because we had a sound economy, was not because, consumers were healthy. It was because the Fed printed a ton of money and sent it to people to spend on things.
Mhm.
It's ridiculous, so that now I guess maybe not 100% of that rally should be wiped out, but like Zoom, for example, has already given back all of its COVID gains. And I know we'll get to ARC in a little bit, but that erased all of its gains since COVID.
Yeah.
And that's supposed to be all the innovation stocks that do good and are all heavily technology based. And so I don't know. I mean, I think the whole market has been propped up on nonsense since COVID. I don't think they ever should have shut down the entire global economy due to COVID, but that's a whole different matter. Because they did shut down the global economy, the market should have tanked and stayed down. It should not have done what it did, and so now it's all kind of coming back around. So none of that surprises me at all.
Yeah. So then turning to commodities, here's our oil trade. I didn't even touch the drawings from last time. Again, just keeps consolidating. Came back down, hit that line again that we drew, worked its way back up. No real update there. Still looking bullish. Gold, there's way better investments out there.
Gold doesn't look great.
It does not look good. Treasuries. Now look at this. You see this green line? I drew that last time. So again, the artistry never ceases to amaze me. If I could just draw the lines, do that, call that my trading, I'd be doing wonderful.
There you go.
You hit that level, came back. I anticipate it'll keep moving higher, but I think I mentioned that in the last video or the one before that, just that I would expect once it hits there to pull back some.
Yep.
Catch some buyers and then start working its way higher again.
Man, what's really terrifying though is that interest rates backed off like that and the market did not rally. There was really no bounce. We've done nothing but go down since the last time we talked.
Yeah. So then here's the next one, ARC. Always a fun one, but again, drawing the lines, they're working. So, we drew this line off all those highs that were set prior to the COVID rally. And then look at this from the last time we had our conversation, came right back up into that line, failed. And now we're catching a bounce right above my other target. I think I like ARC here. If I jokingly said I'd like a bid in at $5 and wouldn't surprise me if it did get hit one day, but you could take a stab right down in here. I think that's fair. Puts you right around the COVID lows. But when you have that much selling taking place without any basing and some sideways action, it's probably not going to work out for some time. But just a perfect example of why you don't catch the bottom on this. It's just keeps surprising us how low it could go.
Picking bottoms is a smelly business, man.
Yeah,
I don't like doing it. Not me. You won't catch me buying anything that looks like that. There's no setup there for me. No,
No,
thank you.
it's one ugly chart.
Yep.
So then here's one. I think this just goes to the idea of, and I got to back up for a weekly chart so we can look at the big picture. But here's Cisco, and here was the best looking company you could own and the best story and everything you want and the best stock ever. And most would say I should hold that till the day I die because it's a great company. Well, we're still what 72% below. So we need a 72% rally to get back to the highs that were set in 2000. So if you're looking at stocks and thinking this is the best name ever, I'll never sell it, you might find yourself, 22 years later, still talking about it and waiting for it to get back to even.
Yep. Yep. And that's what I think we talked about it last week. I mean, you don't need to make back your money that you lost in the stock that lost it for you. There's a lot of other things that have gone up more than Cisco since since it bottomed in 2003. And so yeah, it's just funny. Like this is the number one stock to look at when you look at, the current darlings and all the stocks that are in the ARKK fund that everybody loved all year last year, and they could do no wrong. They didn't need to make any money. Some of them didn't even need to have any sales, and they would just go up every single day, and things were up hundreds of percent. There are a number of stocks that put in highs last year that that people loved and still love, that will never get back to those highs again, ever.
Mm-hmm.
I mean, not ever, not in 20 years, not in 30 years, not ever. And so I just think it's amazing that people behave this way, and knowing what we're looking at right now. I don't know. There's just no reason for people to sit on losers and say, well, I'm just going to wait till it gets back to the highs and then I'll sell it. Like it may never get back to those highs ever.
Yep. And here's another one, General Electric, that in 2000 couldn't pick a better name. Just everything is right about it. Look at this, just a rocket ship. And if you took the buy and hold approach and said, oh, I'm just going to hold this forever and all will work out, now you only need a 550% return
Yeah.
to get back to even.
So many stocks that do that, man. And a lot of them go away because, there's a lot more of them than Cisco and GE. It's just that they got bought out or taken out by some other company or, something like that. And so you can't see their stock chart or where it would be now. But there's a bunch of other ones, and they never get back. They never get back to the height of their popularity. And that's really all it is popularity. It wasn't based on any type of fundamental economic reason to own these stocks. It was just based on the story and popularity, and so too many people bought, and they'll never ever get back to those highs. I mean, some will. Microsoft is another one I think you're gonna pull up. Microsoft is a great company, and the company's only gotten better since the 2000s because it got more heavily into software and has done a really good job. But if you go back to where it peaked in the year 2000. I don't think I can see that on your screen right now. Yeah, right there. And if you draw a line, where that is, and then you go over and find where it finally broke back through that level. You gotta
my chart's going a little crazy. Okay.
Right. No, you just gotta right click the x-axis and auto. That fixes it.
Okay.
But anyway, if you could see the whole thing right now, you would find out that it's 16 years that it took Microsoft to get back to even from its .com bubble peak. 16 years, 17 years. I don't have the exact dates, but Kyle, right click on the numbers, the price numbers, and hit auto. There you go. So anyway, yeah, I don't want to sit and hold a bag for 16 years waiting for something to get back to even.
Yeah. And the way to play these is you don't have to say this is the top, move to 100% cash, go look for something else, but taking some off the table. Now you've taken some profit here. And if it sells off and keeps going lower, well, now you've gotten rid of some of that position. So you're losing less and less as it goes down. But hey, if it goes higher, you still own it. So that's going to help you be a successful investor. But having the mentality that this is just going to go up forever and it's the best company in the world, you're going to end up looking at a lot of stocks that look like GE, and it's just not a good place to be.
Correcto.
So, well, I don't really have much else to cover, Shane. There's nothing I want to buy in this market right now. I think that you got to let it settle down a little bit. Uh, I say just manage that risk, and we could look at broken charts all day, but
Oh yeah, there's no
any
shortage of those right now. So many things down 75%, 80%. It's just going to keep happening. Like that's the kind of market we're in. You can report good earnings and drop that hard. Tell you what I'm looking for is for companies to report bad earnings and then go up. That's
yeah.
when you'll know something has changed, and that'll be when it starts time to, that's when it will start being time to look for longs in this market. But until then, things aren't going to turn on one earnings report. They're not going to turn on one Fed meeting. What we need is for the market to get dumped with bad news and then watch it go up. When that happens, then that should key you in that a phase change is underway and it's time to start really looking for good companies to be long. But we're a long way from that happening. I think we're going to be in this environment where GDP is declining, or at least decelerating, and inflation is also, while staying high, it should be decelerating, probably for the rest of this year into 2023. And the Fed's probably going to be tightening interest rates from here until 2023. And so in that kind of environment, there's just no reason to be aggressively looking to buy stocks. The one wild card, though, is the Fed. You can't trust these guys. So even though they say they're going to continue raising interest rates to try and bring down inflation, there's no guarantee that they will stick to that. These are the same people that were calling inflation transitory until like a month ago. So
Yeah.
I don't buy it.
And let's see. Okay, so it is right here. I wanted to look at one last thing before I missed out on this one. So this is one you got to kind of look at a weekly chart on this, maybe even a monthly. This is the US dollar. So this, I really wanted to hit on this. Look how bullish this thing looks. And when was it bullish before? You had, early 80s up there, 2000. When you have a strong dollar like that and you're raising rates and you start making the rate go higher, that makes the dollar go stronger. And it makes it really hard for, emerging markets to buy anything from us because everything priced in dollars gets really expensive. It's nice for us to travel, but I'm concerned about this right now, having a dollar that strong. I don't know if you've been looking at that at all, but big picture macro thoughts, having a strong dollar like that, I'm not really excited about that.
Strong dollar is bad for things priced in dollars, right? I mean, it's pretty simple. So if you have, whether it's apples or barrels of oil, doesn't matter what they are. If they're priced in terms of dollars, the more expensive the dollars get, the less expensive the other thing is gonna feel like, right? And so everything that's priced in dollars should struggle, all else being equal. As we know in the economy, all else isn't equal. But yeah, I mean the Fed is that, look, they're telling you they want the dollar to go higher. The dollar being higher is exactly how inflation comes down, right? By making the dollar, so you make the dollar more valuable by making interest rates higher, because people will then want to earn that interest rate, and so they'll need to invest dollars in order to earn. You can't earn the U.S. interest rate in euros. You
Yeah.
can't earn the U.S. interest rate in Japanese yen, right? So if you're Kyle from Japan and you want to earn the 3% 10-year Treasury rate in the United States of America, you don't send Japanese yen to the bank in the United States and earn that rate. First, you have to convert your yen into US dollars, and then you can buy the US Treasury with those US dollars, right? And earn that interest rate. So by increasing interest rates, what they're doing is increasing demand for dollars. And unwinding the balance sheet is simultaneously decreasing the supply of dollars, right? So you have supply and demand both pushing in the same direction, and dollars are going to go higher. The good news with dollars going higher is it will reduce inflation. So if if there was only $1 left in the world, it would buy a lot of stuff, right? The moment there are $2 in the world, well, that first dollar is going to buy half as much as it used to, and so on and so forth. So things that are priced in dollars, whether they're apples or cars or gallons of gas or whatever, the more valuable that dollar gets, meaning the higher it goes on this chart, the more barrels of oil you'll be able to buy with that $1, the more gallons of gas you'll be able to buy with that $1. And so um, I know it's kind of complicated and hard for typically for Americans to think about because we don't have to exchange our currency to go basically anywhere. It's other countries that don't have the printing press and don't have the world reserve currency are far more keenly aware of how this works. But in America, we only become aware of it when things get out of hand, which is usually due to some Fed actions. And so right now they're trying to fix their mess up by increasing the value of dollars. And as this goes higher, everything else that is priced in dollars, which means every single stock in the market, right? When you look up Apple, it says how many dollars per share, right? When you look up Microsoft, it says how many dollars per share. It doesn't say how many yen per share. It doesn't say how much gold per share. It says how many dollars, right? So the more valuable the dollar, the less valuable the thing on the other side, no matter what it is.
Mm-hmm.
And so this is how they're going to bring down price inflation, but it's going to have damaging effects on wealth, right? It just that's the way it works. And again, I think everybody probably who has watched this for a while knows if they just stay out of it, these cycles would happen more frequently, but they would be way less extreme. Like we're in an extreme situation right now, and the dollar should go higher. Like it just should,
Yeah.
and that means all the asset prices should come down. So um, anyway, that's a shortest version I can give. We could talk about that for a couple more hours. There's
Yeah,
lots of debate in that world.
absolutely. So, well, I don't want to take up your time, Shane. I've enjoyed the conversation as always, and hope you get some good relaxation in the mountains, and we'll see you next week.
All right, later, Kyle. Thanks, bud.
Yep.